Next section, I want to speak a little bit about the risk that Lars was touching on before, slightly more in detail. So we do believe that we have a low and stable risk profile, and I'll talk you through slightly more detail than what Lars did. So I'll give you an overview of what the full picture of the risks are, and then I'll dig into two aspects which I think are not always well understood of our risk, and then how we manage that risk as well, so how we manage the portfolio. So I start with the overview here. So the credit risk is clearly the most pronounced risk in our book. So this is what we do. This is where our main business risk is. So this is the key, what Fabienne does in everyday working. So we actively invest into diversified assets, and that's the active part of this. So we are very much building it into everyday life, how we manage this risk. So we're not only managing the risk we get on, we are very actively picking the type of risk that we want. And I think it's very clear from both the asset selection that we do and Lars's introduction and Harry's into there as well. And it's all data-driven and statistical. We absolutely don't want to make any big assumptions or big bets, as Fabienne was calling it. And we have then this central check on all of it. And I'll come back to the credit risk slightly. So the credit risk in the liquidity portfolio. So we have a liquidity portfolio on the asset side. It's very much managed as a bank liquidity portfolio. So it's high credit rated papers in this. That's it. And this is how it will continue when we become an SDR as well. We don't want any business risk in this. So it's very liquid, it's very low risk. And that's exactly how we want it. Operational risks. So in terms of operational risk, we believe that we have a low operational risk overall. We are working very actively with putting the right structure, the right organization, putting the right people in there, and it's part of our everyday DNA. So we are never happy with how it was yesterday. We always want to improve, and that is driving these operational risks. And on top of it, we are a highly regulated institution. So we have the highest regulatory standards in our society, so banking regulation, which means 3 lines of defense. It means all sorts of operational risk controls, risk assessments. You need to have ready-made plans on the shelf if something happens. So it's very, very diligent and very detailed. We have crisis management frameworks, etc., etc., etc. It takes a lot of work and it's a lot of toll on the organization, but it is paying off in the sense that we believe that we have a low operational risk. And then clearly there's risk that you cannot fully control. Lars was mentioning cyber, internal, external fraud as well. So ill-intended people can always come around, criminals, either internal or external. And that is slightly out of our control. We try to really minimize it. We train people. We try to recruit the best people we find. We have internalized our IT structure, so we have a dedicated cybersecurity team as part of the IT in-house. So we believe that we are very well prepared and also have the right systems. We're cloud-based. We have all the top-notch standards that you can think about. Market risks. So we're bank regulated. This is about FX. So we're an international firm. So we have a pan-European presence. So we're investing in 11 markets. We have presence in 13. So these investments out of Sweden, we report in SEK, that carries FX risk. So we manage it both by naturally hedging it. So we have deposits locally in the same currency as the assets. So the natural hedge, so the economical hedge. And then we also can use the liquidity portfolio to steer the exposure to certain FX if we would like to, and that we do actively as well. And then the remaining part, which is unhedged, is we take care of that with derivatives, basically, so FX derivatives to cover that risk. So we believe that we have a very, very well-functioning FX situation. And then the interest rate risk is the other part of this. So this is the mismatch between the longer asset side and the shorter liability side. So if you have a shorter liability side, at one point you need to refinance the same assets with new financing, We do it gradually. We do it very on an ongoing basis. We manage it very actively, both by making sure that we try to match the length of the funding to the degree it's economically feasible. And then we clearly hedge also the interest rate risk. It's called interest rate risk in the banking book. So that's a hedging that we have in place as well. The liquidity risk, that's in the liquidity, just meeting your payments, that sort of kind of risk. We have a really big liquidity portfolio, so it's not really an issue. We can sell the papers that we have very easily, so it's highly liquid. So it's a very low risk for us. And now, given the SDR, which I will come back to after the panel of Q&A with the country managers, that liquidity portfolio will grow. So that risk is becoming even less or more remote. So regulatory and statutory risk. I think the most important thing, and I'll come back to this in the SDR section. I think the most important thing is that we believe that we are absolutely aligned with the regulators' intent, what they want to do with the banking sector, what they want to do with the consumers. And we play a very natural role in that system. So that is now reflected in regulation, and we go into some detail later on. And that is an incredibly strong starting point for any company, any person, etc., that you're aligned with intent. So we do believe that this is, I put low to medium, but I do think it's more bordering to the low, if you would ask me. And we also have a SDR status coming up that we're aiming for the 1st of January 25, which gives us this stability of that role. It's level 1 regulated, meaning that it's detailed in legal text. It's not a directive, so it's detailed legal text. And this banking package is meant to be in place until well into the 2030s. So it's a very stable regulatory status that we're now heading into. And that said, regulatory risk, we are a pan-European company, so it's a very complex organization because it's international. So we have structural risks, we have a lot of different subsidiaries, etc. So we manage that very, very carefully, and we believe that we have that risk well managed as well. This is often a misconception that I've met, and I think my colleagues can probably say the same, because what we invest into are NPLs, and NPLs are not the same across. So the risk profile completely changes as you go through a process where you sell an NPL to an investor like ourselves. So in this, we wanted to show, so this is the gross book value of the originating bank, the value of the original claim that we buy. And we buy it at around 90% discount. So 49 billion SEK is this, and 581 billion SEK. So this is from the inception of Hoist, so just to give you a long-term trend. So overall, all the portfolios that we bought since late 90s, that's the amount of gross book value, and that's the book value that we bought. And we have clearly worked through and collected a lot of them, so that's not the current book value for us. So this is a massive discount. And what happens is that someone becomes, for some troublesome reason, divorce, lose their job, etc., they get into debt trouble and cannot pay. Lars was dealing with all of that process. Then they decide they want to sell. The credit risk, as it's called, has at that point materialized. And then we price the true risk based on the investment process that Fabienne laid out. So we look at all the cash flows that we believe statistically will be paid from this sort of bank. And that's the price we are paying. And in that process, 49 is the same here. You get a massive debt borrower relief. So we offer a debt restructuring process to society in which we are much more flexible. We are much more designed to be specialized in that process to help the consumers. And in that process, on average, we take down the repayments with almost, let's say 16-17% they pay of the 100. And that is not well known. And clearly, that risk and that risk is completely different. So that's why we call it de-risking NPL, by pricing the true risk profile of an NPL. And this process leads to this side here. This is also from inception. So this is the initial curves that we set in accumulation, the pink ones. And at the time of investment, that's the cash forecast we set. And on average, across these years, we have collected 108% of that. So it's very, very stable, very predictable. And the de-risking of NPLs is often misunderstood. People see it also in regulation. It was also more geared towards this than this risk. And it's a world of difference, because the credit risk is gone basically when we have bought the NPL. Then the next one page is how we actually manage the book. Because if we screw up managing the book, we will get into trouble as well. So a large majority of all the portfolios that we buy, you can see it on the previous page, we are delivering what we thought we would deliver. So 100% of that initial curve. And then we have a objective with the book to deliver a stable and predictive collection performance, so we can absorb unforeseen shocks, so we can make some mistakes in investing. And this is what we've been building the last few years in the book. This chart here shows the overperforming books in relation to the underperforming books. So it doesn't focus on the large majority, which is just where we thought it would be. So this is based on a flagging system that we have in the centralized governance and follow-up framework. This flags these portfolios on a real-time basis. We look at them in a monthly revaluation committee. If it's large enough, then it goes to the board. If it's slightly smaller, then we deal with it internally in management. And this outlier focus gives us a really strong overview of the health of the book, we call it. So if we have a healthy book, which we often say in the quarterly results, that means that the number of overperforming portfolios are higher than the number of underperforming portfolios. And you can see that the number has been growing steadily, and then and portfolios come in and out of these stables, right? So as we work, we are more or less the same on underperforming, but the overperforming are growing. And that points to a really healthy book. And then the question is, okay, what does that entail in terms of numbers? So a healthy book will, by definition, mathematically give positive collection performance, so above what you actually thought it would be. In our numbers, that means 106, 107 this year of what we actually had in the current management forecast. And this we want to maintain for the reason that's on top of this page. And we're really prudent how we manage this book. So everything that is here, we try to deal with as soon as possible. So everything that is difficult, we want to deal with as soon as possible. We know that pays off, because you really build the performance for tomorrow, and it's easier to deal with issues today than it is tomorrow. These revaluations that come with positive revaluation, we are very careful to do. These we must do because of both what we want to do, but we also have an external auditor that is checking this, and this is their also largest risk. And the positive revaluations, we manage in a slightly different way, in a much more conservative way. So as you know, it's 15-year curves that we invest into. So if you see a portfolio overperforming the first 3 years, for example, you could take the assumption that you build this into the future curve. So overperformance for 15 years. And then it's a pretty big revaluation, positive revaluation. We don't do that. We want to do this gradually, very carefully. So we look at the performance, and then we say, okay, over the next 2 years, maybe that's the positive revaluation we will take on this, because we are very sure that this will happen. We're absolutely sure this will happen. And why do we know that? It's a very simple reason. In this business, past performance is a very strong indicator of future performance. Actually, particularly here. So that's why we deal with the issues early on. So it's a very strong correlation here. I think it's 70% or so, slightly less here, but still very strong. So if something has been performing really well, it is very certain, or not, it's very likely that this will continue. However, we try to only do the positive revaluations slightly and gradually when we're certain. And this, why we do this is to want to have this stable and predictable collection performance, and also be able to have this positive small contribution from our positive book, not only from the normal cash flows, but also from taking some benefit from the health of the book as well as we go forward. Fabienne was touching on feedback loops. So this is integral to this framework as well, because we are constantly learning. It's a really strong culture of learning in the firm. And we do that on the operational side, we do it in the investment side. So the loan management side feeds the investment side with data, and that's an ongoing loop. And then we follow up, how did the investment go? We adjust, and then it all goes into the revaluation of curves. So we revisit these curves very gradually. So we do believe that we have a very high level of insight into the performance of all of our portfolios. And the investment team has done a fantastic job the last few years to centralize all the data, which Fabienne was speaking about. So 3-4 years ago, we didn't have that view. We had a local revaluation of the country managers. They did this themselves. And then the oversight from central, so the checks and controls, so to speak, was not sufficiently strong. And we did it once a year. Now we do it on an ongoing basis. So we are all over this risk, which is a really comforting thing, because we don't want to end up in a situation where something unexpected happens. We want it to be really, really predictable. And clearly, the result is the collection performance we are seeing now. So we see really positive and healthy collection performance on an ongoing basis. The last 2 years, we've been having a collection performance of 105 to 107% or so. I think that was it on the risk side. Well, I think we have a break now, right? So we'll break for 15 minutes. I'm speaking because Harry doesn't have a mic, so the web hears this as well. And we will revert at, shall we say, at 3 o'clock?
Yes, let's do that.
Yeah, very good. Well, thanks so much for listening so far, and we'll be back at 3 o'clock.